All right, let's dive right into this explainer. Today, we're uncovering a silent financial force that literally affects every single one of us. You've probably felt it, right? That nagging sensation that your paycheck just doesn't stretch nearly as far as it did, say, a year ago. It's a topic that usually gets buried in complex economic jargon, but we're stripping all that noise away. We're going to break it down simply and directly to show you exactly why you might be feeling the pinch and how this force operates completely under the radar. So what if I told you there's a tax you pay every single day, but you never, ever get a bill for it? Seriously, imagine a daily drain on your wallet. No government letter, no payment reminder in your inbox, absolutely no receipt. It just vanishes. Well, this is the exact mystery we're unraveling today. This hidden tax quietly takes money right out of your pocket every single year. We are, of course, talking about inflation, and the source material makes a terrifyingly clear point here. If you don't grasp how this mechanism operates, your hard-earned savings could lose a massive amount of purchasing power over the next decade. This isn't just about your morning coffee getting a little pricier, it's about the fundamental value of everything you own, quietly slipping away while you sleep. Let's move on to Section 1, the problem, the illusion of getting richer. Now, earning more money doesn't always mean you're actually getting richer. I mean, most people think they're moving up in the world when they score a salary increase, say a solid 5% raise. You feel like you're finally getting ahead, making real progress in your career. But here's the harsh reality the data presents. If your income rises by 5%, but the overall prices of the goods and services you need to live rise by 7%, you're actually in the red. You're working harder, getting promoted, yet you're literally losing money in real spendable terms. It is an incredibly frustrating illusion because your purchasing power is shrinking. When prices outpace your hard-earned pay raise, you're actively losing ground in the economy. This perfectly explains the modern economic paradox highlighted in our source material. It's exactly why you might feel completely broke or just constantly financially stressed out today, despite technically earning a higher salary than you ever have before in your life. The numbers on your paycheck are going up, sure, but what those numbers can actually buy for you and your family is steadily going down. Which brings us to Section 2, how inflation actually works, unmasking the silent thief. At its core, inflation happens when the amount of money in the broader economy grows faster than the actual goods and services available to buy. Think of it simply as a giant game of musical chairs, but with cash. When more and more money is printed and enters the financial system, but it's chasing the exact same amount of products sitting on the store shelves, well, those prices have absolutely no choice but to rise to absorb that new money supply. And you see this reality play out right in the grocery aisle. Take the price of a simple loaf of bread. Years ago, that loaf cost you just $1. Today, that exact same loaf might cost you $3. Now ask yourself, did that bread get 3 times tastier? Is it 3 times more nutritious? Did the bakery invent some revolutionary new flour? No way. You aren't paying more for a fundamentally better loaf of bread. The bread itself didn't become more valuable. Your money became less valuable. The physical product hasn't changed a single bit. It's the exact same recipe, baked the exact same way. But the purchasing power of the dollar bills in your pocket certainly has changed. It now takes 3 of those bills to do the exact same job that one single bill used to do. That is the silent thief in action, eroding the foundation of your wealth without changing a single thing about the physical world around you. Let's look at Section 3, the silent wealth transfer. Who wins and who loses? So society is essentially split into 2 by inflation. On one side, we have cash savers, people who diligently hold large amounts of cash in traditional bank accounts. The tragic result here is they consistently lose purchasing power over time. On the other side, we have asset owners, people who own businesses, real estate, and stocks. For them, their assets actually tend to rise right along with inflation, often matching or even beating the new cost of living. So while most people try to do the traditional, quote-unquote, responsible thing by saving cash and end up losing ground, the wealthy own productive assets that actively benefit from rising prices. Moving into Section 4, why cash is risky, the danger of sitting still. Think about how cash actually erodes over time. It starts with a smart move, saving an emergency fund in cash. This is absolutely vital. Everyone needs a safety net for sudden expenses. But then, you experience an average annual inflation rate of, say, 3%. Year by year, you literally watch your money buy just a little bit less. Over decades, that slow drip results in a dramatic loss of purchasing power. The profound takeaway here is that while keeping some cash for emergencies is smart, keeping all your wealth perfectly still turns what feels like a highly safe decision into an incredibly risky one. The silent thief is always taking its cut. Let's wrap this up with Section 5, the Smart Investor Playbook, Fighting Back. Successful investors shift their focus entirely to fight back. Instead of just hoarding cash, they focus on preserving their purchasing power by consistently putting their wealth into historically proven growth vehicles. They buy stocks, they invest in businesses, they acquire real estate, and, crucially, they continually invest in their own skill development so they can demand higher wages. When you allocate your capital and your time here, you are attaching your wealth to productive assets that have historically outpaced inflation. You're essentially building a fortress around your purchasing power. Because the ultimate goal isn't just to save money. The goal is to make your money grow. Saving wisely is just step one. It's merely the baseline to keep you out of debt. But investing consistently into those productive assets and thinking in terms of decades, that's how you actually protect your future and build real, lasting wealth. You have to put your money to work so it earns more than inflation takes away. As the old saying goes, the biggest financial risk isn't always losing money in a bad investment. Sometimes the biggest risk is watching your money slowly lose value while sitting perfectly still, doing nothing. Doing absolutely nothing with your savings might feel incredibly safe and comfortable in the short term, but economically speaking, it is a guaranteed way to slowly lose your hard-earned wealth over time. So, now that you know the truth about this hidden tax, what will you do with your savings? Inflation isn't going away. That's an economic fact woven into the very fabric of modern financial systems. But once you understand the mechanics of how it works, you have the power to position yourself better than most. Take this knowledge, rethink your strategy, and decide how you will protect your purchasing power starting today. Because ultimately, the people who understand money are the ones who benefit from the changes that catch everyone else completely by surprise. Thanks for joining me for this explainer, and I'll see you in the next one.